Hi everybody, this is Also Hub. I'm Giacomo, and today I'm again with Jennifer Warren. She is from Concept Elemental. She um, is a speaker and she's focused on the oil and gas market, especially in Texas, where she's based in Dallas, right? And today we're going to talk about some of the trends in the industry of oil and gas industry, the consolidation that we're witnessing. So Jennifer, please introduce yourself for those that don't know you yet, and then we'll get into the topics of today.
Sure. So yeah, I would really characterize myself as, you know, kind of one of my claims to fame is just that I've chronicled the shale booms since they started, starting with the gas shale boom in like 2008. And so I've really been looking at it from an agnostic point of view, like a resource point of view. And, but also looking at other energy sources, like in 2008, even at that time, Obama was in office. And so there was a lot of talk about renewables as well. So I've always kind of toggled back and forth about, fuel sources, how it impacts resource efficiency and capital markets. So I kind of come at it from an economic point of view, a capital market point of view, and then a resource efficiency point of view. So, and obviously in Texas, oil and gas is a huge part of the economy here. And I'm in North Texas, so I just sort of landed in these stories, if you will. So
Okay, shall we start with the presentation?
sure, sure. So let me get back to the beginning.
Yeah, yeah.
So this is just, again, my consultancy is Concept Elemental, and I have a resource communications and advisory boutique. And sort of this helps kind of explain it in images. So this map over here is the shale basins of the United States. And once I started chronicling the gas booms, which largely happened here in North Texas, like right here. This is Dallas. Really, it was right in North Texas where the gas boom really came into full view. And that was like in 2008 when I wrote about it. And then in 2013, the action really shifted to the oil boom, and that's the Eagle Ford and the Bakken up in Montana and North Dakota and here in West Texas in the Permian. And that's when it got real and a lot of money started really, coming to the fore. And this is just a photo of a really neat ranch in the Panhandle called the Turkey Track Ranch, and I've kind of looked at it from an asset portfolio point of view. So alongside oil and gas, I look at land related assets and that sort of thing as well, and their sustainability profiles. Natural capital is one word for it. So yeah, and the big story is industry consolidation, and just calculating seven merger announcements in like the last 6 months, pretty much $181 billion being spent. And that's amongst seven. I kind of was laughing because how everyone talks about the Magnificent Seven, the tech. Well, there's kind of a magnificent seven here as well. I ended up calculating, and obviously the big names are Pioneer, Exxon, Chevron, Hess, Chesapeake, Southwestern, and then there's others. Exxon bought Denbury. And then the other big one that just happened recently is Diamondback bought Endeavor, which is a private operator that had really amazing assets in the Permian Basin. Now, why this is happening? It's happening because of capital discipline amongst the public players, resource discipline, production discipline. It's an efficiency play. And I think a lot of this action was catalyzed partly by the pandemic, partly by net zero and the desire to reduce greenhouse gas emissions, and then also by these wars. I think the wars and the geopolitical context has also really kind of pushed things. And oil prices are in kind of a Goldilocks sweet spot range. And so there's a little bit of stability in that. And so, firms are making their plays. And it's really interesting because it's a different dynamic than at the beginning of the shale booms. But also, I think a lot of innovation can come from this with these big players that are going to be very well capitalized. They will be spending on innovation in decarbonizing. So I think that's the good news here as well. And then there's going to be a lot of small niche firms that are going to be able to, show their wares to these big players and help solve some of the issues to do with, cleaner molecules, grid challenges, infrastructure mismatches, that sort of thing. And again, sort of the big story is, the Exxon Pioneer story. And this is just a cover story that I wrote in 2021. And that's Scott Sheffield, of the CEO of Pioneer. And in interviewing him back then, he was even talking about that industry consolidation was going to be happening. And they had actually done a large acquisition themselves during that time frame, and we were just coming out of the pandemic, and so things were not as clear as they are now, so to speak, in the industry. I think there's a lot more clarity, and I think that's what these mergers reflect. Another big deal is, again, the Diamondback endeavor, $26 billion to acquire Endeavor. And that's going to create one of the largest independents in the Permian. Now, Pioneer used to be like one of the largest independents, if not the largest independent in the Permian as far as production went. And now, they're being acquired by a super major. So Diamondback will be like a Pioneer, And then Chesapeake is a gas play, large gas player, all basins all across the United States, and they acquired Southwestern for $12 billion. So again, you're seeing this consolidation, and the natural gas firms have really had more struggles than those that have greater oil weightings. And so in doing this really brings kind of a rationalization back to the industry. And in fact, Chesapeake just sort of let the market know that, we're going to have capital discipline. We're going to have production discipline, because natural gas prices were almost too low, for proper profitability. And again, you can't really talk about oil and gas without talking about Texas. It's a really large part of the export story in Texas. And this is a chart from a recent Dallas Federal Reserve Bank event that I attended. And basically, exports are why. So on this line, we talked about this before, US exports kind of flat. If you add Texas in there, they're much higher. And we actually accounted for almost 20% of the LNG volumes imported globally in 2022. Now, that's the year that Russia invaded. So, that really sort of helped change the game to some extent, enhancing really the visibility of US LNG, if you will. And just for a number, if you add Texas and Louisiana, that's $315 billion of energy exports, which is 83% of US energy exports. So the lion's share of our energy exports are happening at the Gulf Coast. It's a really dynamic place. And I think that's where, a lot of innovation is going to happen. So our exports are up. And this is just to note, putting a pin in the idea that, this was from 2008 when I wrote about the gas shale booms. And really, natural gas was starting to reveal itself in the shale era as commercial back in the early 2000s. And then I wrote about it when it was really, really apparent as a really, North Texas story that you could wrap your head around. And even back then, in 2008, everyone was talking about how natural gas is a way to reduce emissions relative to coal. So that was, we're at how many years now? 12, 16 years. We're still having the same conversations and arguments. And back then, even Chesapeake was a really notable player, and they've gone through a lot of iterations and a bankruptcy, and have kind of come out, kind of have this comeback story, if you will. This is just noting, this is again another feature I did in DCEO in 2022, and it was about shale gas and an entrepreneur that was really there in the beginnings, in fact, a pioneer in the shale revolution. And he is in Europe, working to help the UK and Spain develop their own resources because they have a lot of gas resources. And therefore, they would be ultimately reducing imports. And then the other thing I'll note is that European LNG imports were up almost 60% in 2022, and 43% of Europe's imports came from the United States. And I kind of did an analysis of what was happening with LNG during, with the Ukraine invasion, that pipeline production from Russia, how that was going to shift around and where the action was and who gets the LNG trade as a result of it. And BP did an analysis, and I sort of parsed that analysis in a video, and it's noted here. It's ripple effects from war, decarbonization, and investment. So there's a lot of charts and data in there if anybody's interested. And this is just noting about natural gas and LNG. I know that, there was a lot of friction about the Biden pause of LNG permits. And basically what that would affect would be the LNG in the second half of the 2020s, if in fact the pause stayed a pause. It doesn't impact what's coming online between 2025 and 2027, which is an expansion of LNG. And so, again, that's just kind of this political season. And the industry, from what I heard when I was at the NAPE Expo conference in Houston, they were not super worried about it, that things will work out, and that, in a complete and fair evaluation, it will be shown that our LNG exports are in fact, in a total way, it's a cleaner way to go forward, in a global sense. And I just wanted to note too, just the developing world is really driving demand in natural gas to 2040, and the majority is from Asia. And this is just something we talked about last time, just that US LNG has added liquidity and depth in a market that didn't exist before. And what we're seeing now is, even with this Chesapeake merger, that's part of that story, that, we're going to have these players that are market driven in LNG. And that's a good thing, because that market liquidity is kind of people power, and shareholder power, right? This is just noting here, this Texas Louisiana energy exports. This is in billions. There was like 315 billion in 2022. The lion's share is crude oil exports. Next is natural gas and natural gas liquids export. Considerable amounts of money. And we looked at this last time, just kind of showing, the jewel tones of green and all is representing those areas that are importing LNG, and then the warm tones are the exporters. And North America is not on here, but obviously we're a large exporter. And this is just showing here this emerging Asia gas demand to 2040. It's nearly 10% per annum here at the end. And the lion's share is LNG imports, and then next by pipeline. And so this is just kind of looking at a year view of some of the stocks related to all this. Now, XLE, a lot of its constituents are the majors like Exxon and Chevron and that. And then I put Triple Q in there just because I want to, there's always this sort of, play between the energy stocks and the tech stocks. It's kind of a rolling conversation in markets that I have. And here we have Chesapeake, the green. AMSA is an infrastructure ETF. It is actively managed, and its return was 18%. It actually did quite well relative to other oil and gas stocks. Now, mind you, the performance is a bit, moderated because oil prices were in this kind of lower range. There was still all this concern about recession, soft landings or not. where are interest rates going? How's that going to impact projects? And as you can see, iClean here is a clean energy ETF. The performance in those areas, in those funds, have still been kind of on the lower side, as interest rates have kind of, changed the calculus on the sentiment with that. And then lastly, I want to show a 1-month look, because sort of the narrative's changing a bit. And I think as the market digests the meaning of these mergers, it's kind of like a little bit of an energy comeback. Plus, you have oil prices that are, staying solid in the $80 range, and OPEC is, keeping supply on the tighter side. U.S. production also being, moderate, and then with all these mergers, you're not going to have as many firms all trying to, put the pedal to the metal on production anymore. It's going to change the dynamic. And so what you can see here is Chesapeake actually, 6% in the last month. And here's right here at the bottom here, I don't know what day it is, February 18th or something. Its stock shot up, and that is because they came out to the market and said, we're going to slow production down, and all the natural gas players kind of took a cue, play from that playbook. So it was a positive news for the industry and for future profitability, because in the end, for these firms to survive, it has to be profitable to produce. And if prices are too low because everyone's, pumping full out, it's just not going to work. And not that they are pumping full out, but you know what I mean? It's just kind of a restraint in growth. And just something I wanted to mention too. So XLE, like I said, it's got more majors in it and the heavyweights. And then XOP here, which has done well, is more reflective of the independents, really US independents, like the FANG. FANG is Diamondback stock. I'm not sure if I have, I didn't write those down, but that's what that represents. And iClean, the clean energy is still kind of struggling. AMSA, the infrastructure, doing well. And there's a lot to that story for another day. And a lot of the oil producers are merging and consolidating, and that will impact and trickle down to midstream as well. And then finally, I just wanted to leave with just a little bit of emissions reduction color. This is related to LNG, but also just with a lot of this consolidation and attention. I know that resource recovery, more efficient resource recovery, is really something that's going to happen, has to happen. I've been talking about it for like 2 years, and the industry's serious about methane reductions, because it's you get more bang for the buck quickly over carbon emissions, focusing on methane emissions. And so I just wanted to mention that in LNG, this is from Shell's analysis. They just put out an analysis on LNG that nature-based approaches can reduce emissions via bio-LNG by 100%, or 100% by offsets, credits. So that's one interesting thing. And there's a lot to all that. Tech and efficiency just achieves like 10% reduction. CCS, carbon capture, 80% reductions. Now, there's a lot of attention and money being spent in the United States on that and elsewhere around the world. And then just noting that the idea of these cleaner LNG cargoes, that there's a premium for clean, and US LNG is going to represent, I think, some of those clean cargoes increasingly in the future. And Taiwan was one of the first importers of said cargo. And then finally, I just wanted to note that, there's a lot of friction, there's a lot of politics surrounding all this, and some of the cracks are starting to show in California. And one thing that has happened, and there was a chart that I remember from the Federal Reserve event, that there's a lot of migration from California and New York to Texas. And some of it has to do with, what's happening with policy and so there's capital flight as a result of it, and human capital flight as a result of it. And Texas is a big beneficiary of some of that shift and that growth. And, the calculus, if you do the math, and this is kind of what this story gets at. If you do the math on energy demand and, the density required to power the globe and with population and economy, the maths don't work eliminating fossil fuels soon at all. And that's what's really clear. And I've been talking about it for a lot for the last couple of years regarding the energy transition, and that, I don't know what a rebalancing of this looks like. I just know when I see what's not working. And so I think it's going to take time, and, for us to decarbonize, and it's going to take oil and gas and everything, all energy sources in combination, in diversification. So I'll stop sharing that.
Okay, you talked about a lot of interesting topics that are going on. So I wanted to get your point. Is there, maybe it's more an opinion rather than, a factual thing, but I try to understand what's going on. Is there a change of, how, for example, ESG ratings are perceived, and given the fact that we're not leaving fossil fuels anytime soon for now, is there a change in perception because Europe needs energy, the US needs energy, and yeah, it's the US as as an exporter, it's very important for all its allies. Do you see a change in, this the strategic understanding, the strategic importance of fossil fuel exports?
Yeah. No, I mean, I know what you're getting at completely. And I think the narrative is changing. In fact, I'm going to be speaking at an investor conference that's during the time of South by Southwest in Austin on the 11th and 12th. And actually the panel I'm on is called Post ESG.
Okay.
And and that's just reflective of, there's still a lot of attention on ESG, right? There's still a lot of, influence, influencing fund movements, capital movements, absolutely. But I think there's a rethink about, what it can actually achieve, right? And I've never been a big, my mantra is more sustainability in terms of resource efficiency, capital efficiency, looking at it really pragmatically, really holistically, because if you just look at things narrowly, it doesn't capture the reality of the world in which we live and how energy moves these economies and how we need energy. It doesn't capture the idea of, physics and energy density and economic efficiency. It doesn't capture any of that, nor does net zero, right? So if you're targeting ESG, net zero, now net zero as a goal for an oil and gas company, to reduce their emissions and have that kind of goal, that's one thing. But in its entirety, we're part of this really large energy system, and we have to produce energy for the rest of the world, including Europe, at a price that can be afforded, like, for example, as we saw with Germany, with energy costing so much more, there was a lot of capital flight and industrial flight that has happened as a result of the Russia invasion of Ukraine. And so I think the stark reality of the need for energy to be produced, and accessible and reliable for people, I think there's that trade-off. Are you going to trade off reliability of your energy supply and source and affordability for decarbonization? Where's the tension in that? There's a lot of tension in that. And so I think that is playing out absolutely with policy, probably in Europe and through elections. And here, now here, I think what gets missed is in the United States, we have a lot of energy and we take our energy for granted. We take our resources, we take the oil and gas industry, we take our infrastructure totally for granted. And that's, real apparent in the politics of it all that's kind of flying around. And, in Italy, you don't take it for granted. Germany's not taking it for granted.
I
And,
know.
so I think hopefully there's some, I think the industry is very sensible and they see it and they know what they have to do, which is, okay, we do have this greener push. So how do we decarbonize our industry? How do we reduce greenhouse gases? I think that's there. So there's this balancing equation, right? And I think, it's not reflected completely in the market either, with like the triple Q versus XLE, how fundamental and vital the energy industry is and how it really drives an economy, so I think that gets missed to your point. Um,
Okay, okay. Another question I have, without being political, are there any regions that are important for, production that might go the same route that might go to the same route that California has taken?
yeah, well, we
You
do have,
outlined some of those.
yeah. Yes, sure. So yeah, there's absolute tension and it's partly on our East Coast. It's partly like for example, Appalachia and the Marcellus, the big gas basin there. You see some of those politics play out in terms of them not having the pipeline capacity, to match the supply and the production that could happen there. And so they have to actually, there's some importing that comes from like the Texas back up to the Northeast, in fact. So you see some of that in, politicized. Yeah, there's the California story. So but really in the center swath of the United States, and I've talked about this before, the 10th and 11th Fed districts of the United States. I was at an energy conference of theirs in the fall. It comprises $4.5 trillion of GDP. It's largely energy, manufacturing, and ag. It's like the heartland of economic activity, right? And so I think that, with a lot of the policy, the intent of the policy to become cleaner, greener, and decarbonize, green up your grid, it's all good, but you have to kind of do it smartly. And I think there's got to be a more balanced approach going forward, because one thing that I did hear in that conference, there will be in the future a mismatch between incremental supply and demand, the takeaway capacity on some of that. So to your point, yeah, it's an issue, and I don't know how and when that gets worked out, except that in the end, the market tends to rule over time through administrations or not. The market and people's necessities tend to rule, which is why it's really a good thing that we do have this, market liquidity in the United States that I talk about a lot.
Okay, okay, okay. And the last question that I have, so we talked about the US, we've talked about Europe, we've talked about Asia. We haven't talked about Africa. I don't know if you follow some of the things that are going on. Is it's what is the sentiment over there towards Africa? Because some people see it as an opportunity. I know that a lot of American companies have operations, for example, in Angola. I think that some countries are boosting their production, like Congo probably, and Algeria, and so on. Are American companies looking to expand in that continent like they're doing in Europe?
Mm. Yeah, my short answer is I don't have a great answer on that. I know it's just, it depends on the various firms' production areas. Like for example, Chevron, they have global operations. Exxon, same. it seems like there's a lot of action in Latin America, right? Like we've talked about. I don't follow the Africa story that clearly, but I know there are absolutely there's opportunity there, and I know that a lot of the European majors, they do have like legacy production there as well, right? But there's, US companies right alongside. Some of the global play, which is what I think you're getting at a little bit too, where some action is Australia, and there was somewhere else. Oh, the Vaca Muerta in Argentina, the shale play there. I wrote about the Vaca Muerta back in 2015, 16, when I was looking at what other shale plays looked like. So I think it's a lot of it's going to be driven by, what's the return? Do we need to explore for new resources? Because that's expensive. And when you have all these shale basins, where there's a lot of infrastructure, you can get those costs down, that cost per barrel down. So I think that's what this consolidation's about. Not that at some point, there's not going to be other opportunities. There's always going to be smaller players, doing different things depending on their relationships as well, and their competencies. So it doesn't seem like there's a big Africa story, just from what I hear and what I'm around, because there's so much happening here that's so efficient that the idea of further exploration,
Yeah,
it's
probably from an
it's
American standpoint, it's
it's
very focused in
there.
the US right now compared to
But
in
yeah, but
Europe.
if it's a market-driven approach, right? The market, whatever the market dynamics are, it's going to rule for now, and that can change. There can be discoveries and all sorts of things. And I think some of the geopolitical risks surrounding the Middle East and all that is not helpful. It's not helpful for the development of Africa, frankly. And so I think that geopolitical risk weighs in as well. And so there's a lot of work to be done, in getting these wars tamped down so that, there can be greater economic prosperity, that there can be and should be, right?
Yeah.
Mhm.
Yeah, talking about Argentina, you mentioned Vaca Muerta. I think that for a long time, companies were afraid to go there because they were afraid the Argentinian government would nationalize their operations there. But we'll see if they uh, will be more reliable from now on.
Yeah. Yeah. When I was writing about it in 2015, 2016, it's on Seeking Alpha, some of those articles, Chevron was a big player there. That was the big play. And then, their national oil company as well. I forget the name of it, but
YPF, I guess.
yeah, YPF. Yeah. Yeah.
Okay.
So
Okay, so I'm done with the questions. Jennifer, it was very nice to have you back on the channel. So make sure to reach out to her on her website, on her YouTube channel, Seeking Alpha, whatever. I'll put all the links in the description so you can reach out to her. So Jennifer, if you want to add anything else, feel free to do so. If not, I really want to thank you for taking the time.
yeah, I mean, all I can say is I know that there's concern in Europe about US LNG and politics. And I just want to say that, I think there's a lot of support and awareness of the necessity of helping Europe, and helping Europe with their energy sourcing, and also with a mindfulness of decarbonization. But I think the priority is very well understood, regardless of whatever rhetoric one hears. And I think pragmatism will prevail in the end. So
Okay, good to know. Good to know. It's quite a interesting year with all these elections, and it's good to hear that. And so, yeah, we can expect you have a bit more clear idea of what to expect going forward. Okay.
yeah, I'm sure we'll have lots to talk about. Yeah.
Yeah, for sure, for sure. Okay, so thank you again for taking the time and sharing your knowledge. So this is it for today. I'm Giacomo. This is also Hub. See you next time.